You're still watching the market right here on ET Now, and the big event, like I said, that will be the cynosure of all eyes into the last wheel of the session today will be the RBI credit policy review. And not that the market is expecting fireworks from that meeting, but even so, it's important to put things in context, given that all that's happened globally over the last 3 days has been largely led by the expectation in world markets that with concerns of rising inflation, central banks may have to move towards adopting tighter monetary policy in the wake of a growth environment which seems to be picking up for the better. So Kaushik Das, who's India Chief Economist at Deutsche Bank, joins us in our studios right here to discuss what to expect from the big central bank event later today and what the commentary would indicate about the path ahead with regard to rates. Kaushik, it's great to have you on the show and in the studios. Thanks very much for taking out the time. So no change on rates, but can they indicate that things can change in the second half of this year? I mean, there's a faction of the market that believes that the RBI could be talking a rate hike soon enough.
Yeah, so it'll be a very interesting policy, not for what they do with rates, because I think they'll be on hold, but what market participants will like to kind of hear or see is what kind of guidance they give. And the risk is that the guidance is expected to be very hawkish. And it can go to the extent of them deciding to change the neutral stance they have to an outright hawkish stance, which then probably will indicate to the market there could be rate hikes going forward.
And so are you penciling in a rate hike this year itself?
So,
but I'm saying calendar year.
So calendar year, we were expecting no rate hikes because India is not ready to absorb rate hike kind of a shock, because 2016 we had demonetization, 17 we had GST, we are still settling down. Economy is recovering, but not to the extent of potential growth rate. So there's output gap which is still negative. To that extent, there's no case for a rate hike. But given that we have had fiscal slippage, US 10-year treasuries close to 270, 280. Oil above 65, RBI could get more hawkish and indicate earlier than anticipated rate hike cycle.
Okay, this whole concern about inflation, which is in India as also across the world, how do you kind of position for it right now? Do you think it's real, or is it just the market running ahead of itself?
So the way to think about inflation is definitely inflation has bottomed in India. We've seen lower inflation last year, but to the extent of what you expect going ahead, inflation should be close to 5% or slightly above 5% in April to September of 2018, even without this MSP confusion. To that extent, RBI would need to be more forward-looking, and if growth is coming back or recovering in a bigger than anticipated manner, RBI would tend to be more hawkish. So I think, yes, inflation scare is more in 2018 compared to 2017, and given what happened to oil prices, you need to be more cautious.
Follow-up question to that would be that what can Reserve Bank of India do to really comfort the bond market? I mean, for me, that is the worry. We may look at the absolute percentage and say, okay, bond yield has gone up from 75 bips. But frankly, that's because of that extraordinary condition which got created because of demonetization. So what do you think Reserve Bank of India would say, indicate or tell the bond market that what the comfort range for Government of India is, and where do you think the 10-year paper should be?
Where do you expect the 10-year paper to be, given how bond yields have spiked at this juncture?
So, bond market is reflecting about 50 basis points of rate hike possibility. So if you see the 10-year bond yields about at 760, it's too high compared to the policy rate that you have at 6. So the question is whether RBI actually signals a rate hike, or if it doesn't, then it's a problem of demand-supply equation in the bond market. So supply is too high and demand is not that much. So I guess it should settle down somewhere on the lower side going forward if the demand comes back for buying bonds. But this is definitely something which is kind of a indication of a problem on the demand side of the bond market. So it's just not a reflection of rate hike or macro of inflation having increased. So bond yields are not actually reflecting just the macro scare. It's also reflecting a problem on the demand side of the bond market. So if RBI doesn't hike rates in 2018, it should kind of settle down lower than where it is today.
Oh, that's actually heartening to hear. And I just want to very quickly, take our viewers once again through the rationale of why there would be no policy action this time around. A rate cut is definitely off the table. That's, I think, something that the RBI has already indicated. They are keeping a close eye on inflation trends. Not that inflation has picked up in a meaningful manner that would concern the central bank, but even then, it is one of the variables that central banks have top of their radar at this juncture. It's not just about what the Indian Central Bank does, but globally as well. It's really the top risk right now. So the CPI level is seen in line, but upside risks continue to emerge, is what the RBI had stated earlier on. And they believe that the stage of growth recovery is still nascent. It's not conclusive as yet. So we have to sustain above 7.5%, go into that range, be in that range for a while before the RBI can draw the comfort that growth is back on track. But Nikunj, that's where it's always a close call for any central bank, right? The balance between growth and inflation.
And that's my that's my question also to our guest, Mr. Das, that what is the need of the hour? Because globally, if inflation scare is making a comeback, Mr. Das, the priority has to be controlling inflation. And we know that Reserve Bank of India historically has maintained that, our priority is to control inflation. There is election next year. We know that, MSP prices would be changed. If government spending increases, this will have an impact on inflation. So what should RBI do? Focus on growth, which is need of the hour, or control inflation, which is the necessity?
RBI's biggest priority is, as you mentioned, inflation management. So to the extent that inflation risks are to the upside, given that oil prices are higher and what you're seeing globally, and just as Tanvir mentioned, it's just not like India. If you see, Korea and Malaysia has hiked interest rates earlier than what people had anticipated. So I guess RBI will give more importance to inflation management, inflation expectations management, because if you see the inflation expectation survey of households, that has clearly shown a kind of bottoming trend and actually is increasing. RBI will release the inflation expectations report along with the policy, and you might see a further increase in inflation expectations. So definitely RBI will give more importance to inflation management, and any kind of fiscal slippage risk also brings along with it a risk of higher pipeline inflation. So to that extent, RBI would be more cautious on the inflation front. But just one point, the good part is that RBI was judicious enough not to cut interest rates too aggressively in 2017. So that leaves a buffer with RBI also to possibly delay any kind of rate hike action. So if you see the inflation forecast for FY19, it's supposed to be on an average 4.5%, and if your policy rate is 6%, you can still manage 1.5% positive real rates for 2019. So to that extent, RBI possibly could delay the rate hike, but obviously they'll put more importance on inflation going forward.
So my next follow-up question would also be based on the fact that if inflation is making a comeback and if rural economy is making a comeback, when do you think the real underlying demand will be captured? There is high frequency data like tractor sales, two-wheeler sales, diesel consumption. They're pointing to a mend in the economy. What is the importance of the high frequency data, and how could that influence RBI policy? Because directly or indirectly, I get a sense, Mr. Das, personally, that for India, a new demand and a new profit cycle has started.
Yeah, so definitely, we are seeing signs of, green shoots of recovery. We are seeing all this IIP growth and core infrastructure production, PMIs, all kind of showing an uptick. But remember that we kind of went down significantly, due to temporary shocks like demonetization and GST. Our growth fell below 6%. From that depressed point of, number, you are going back to a kind of normal state of level of 7.5%. So definitely October, December GDP growth, when it comes out, you'll see better than the July, September number. It should be close to 6.5%. January, March of 2018, you should see a number close to 7.5%. But this is just going back to the level that you were before demonetization. To that extent, you are still not close to the potential growth rate, which in my view is at least 8 to 8.5%. So even if you achieve 7.5% growth, in FY19, the broader point to remember is that you would be below the potential growth rate of the economy. The output gap will still not close, and therefore RBI should be cautious about thinking whether they should hike interest rates. And the problem with rate hikes is that one rate hike nobody will believe. So the moment RBI signals just one rate hike, markets will think RBI is expected to hike even more after that one rate hike, and damage could be done in the sense interest rates could be rising, and that could lead to a slower growth recovery than what we are anticipating. We are going with a 7.5% growth for FY19 at this stage, but if RBI signals a rate hike, then possibly there could be some downside to that growth estimate.
Okay. Final question then, Kaushik. What are the chances the RBI would take the plunge and signal, prepare the markets? It's like you said, a risky call right now, timing-wise.
I think it's not just inflation and growth. RBI will also keep a watch on what's happening on the global front.
Exactly.
The way US Treasuries are moved up, oil prices are definitely at an uncomfortable level. So, and you're seeing kind of global financial market showing volatility. To that extent, there is a risk that some members turn more hawkish out of those 6 MPC members. And I don't rule out the possibility of RBI signaling a more hawkish stance compared to the neutral stance, although I'm expecting they might still hold for a neutral stance and wait for more GDP data to come. But it could be the case that they turn into a hawkish stance from this policy itself.
Mr. Das, a
Kaushik, we let you go at that. Thanks very much.
Thank you, Tanvi.
Taking out the time to be with us this morning and take us through what your expectations are from the RBI credit policy review. It's